2025 has been an eventful year. We've witnessed some of the most remarkable shifts in global economies, trade, politics, and diplomacy in peacetime. Are these becoming the new normal? Let us hear from the speakers of our next panel. Please put our hands together to welcome our moderator, Arthur Yuen from the Hong Kong Monetary Authority. And joining him on stage are panelists, George Elhedery from HSBC, Bill Ford from General Atlantic, and Colm Kelleher from UBS. Can we also have Colm Kelleher from UBS? Oh, sorry. Bill Ford from General Atlantic, please. Okay.
So we're waiting for one more panelist, Bill Ford. Bill, where are you? Please raise your hand if you're in the room.
I think he's coming this way.
No.
Thank you very much. Bill Ford from General Atlantic. Arthur, over to you. Thank you.
Thank you. Thank you very much. Welcome to this panel. So thank you very much to Georges, Bill, and Colm for joining this panel. So you've heard the developments in China in the previous panel. This panel, we look at it from a slightly different perspective. We look at macro trends. Hopefully, the two panels together will lay the foundation for more in-depth discussions on topical issues for the rest of the morning in the other panels. So if I poll the audience for the major macro trends that really matters for the financial markets today, I think it would be fair for me to say that it come up with a list of the following issues. The first and foremost, I'm sure trade and related supply chain dynamics would come up first in the list. And then I can't use the term green anymore, I think. But it's fair for me to say that decarbonization and sustainability-related dynamics would continue to be on the list. And then wealth management is seeing a lot of changes in dynamics as well, so that would also feature on the list. And I don't think that list would be complete without any discussions about AI-related investment recently. And finally, in my recent dialogue with fellow banking supervisors around the globe, the topic of deregulation and simplification keeps coming up. So I think that would be another topic that macro trends that we need to cover in this panel. We have 25 minutes, slightly more than 20 now. See how much grounds we can cover in those 5 areas. So let us talk about the trade and supply chain dynamics first. Let me turn to Bill. Bill, you served on the boards of ByteDance and also the National Committee on U.S.-China Relations. Can you just quickly share with us your take on the trade relations between China and the U.S., given the more recent developments?
Yes, thank you, Arthur, and thanks for having me here. I think we've reached a new and more stable equilibrium in the U.S.-China relationship, as evidenced by the meeting between President Xi and President Trump last week in APEC. And I think despite some of the noise on the surface related to tariffs and some of the exchanges back and forth on trade, I think below the waterline, there was actually a much more constructive engagement, as evidenced by Secretary Bessent and some of the Chinese leaders in their 5 meetings during the year. And I think it set the stage for a very constructive meeting where 2 major things were accomplished. One was, fortunately, there was a TikTok agreement, final agreement, and second, a pause in any trade actions for another year. And I think it sets the stage for a much more positive and I think stable relationship between U.S. and China in the next year. So I would say it's on a cyclical upswing, despite some longer-term challenges related to national security and competition and technology.
Yeah, thanks, Bill, for that very comforting remarks. Certainly, dynamics seems to be sort of, at least the temperature seems to be coming down a little bit recently, given the dialogues going on. You mentioned more stable equilibrium. I think equilibrium is one word, stable is another word. I do hope that stability would continue, but given what happened in the past 7 months in the trade fronts, stability seems to be a very scarce sort of commodity to go by. Should we be worried about the stability part of it?
Well, I think we've had a lot of volatility in the relationship going all the way back to the Trump's first term, and really a lot of movement in policy on both sides. But I think there's a recognition that both countries will benefit by a more stable and more predictable environment. And I think that was my takeaway from last week's meeting and some of the build up to it in sort of the lower level meetings between Secretary Bessent and everybody else.
Thanks, Bill, for that remarks. Let me turn to George. Supply chain uncertainties, definitely there's a very important sort of developments going on in the financial markets as well. Now, HSBC actually coined the terms Asia by Asia, I think, right? So can you share with us your take on that in terms of supply chain dynamics changes?
Thank you, Arthur, and thank you, Eddie, for hosting us, bringing us together today for the next few days. Few observations I'd like to share on trade and supply chains. 5 observations. The first one is just echoing what Bill has said. On the 2nd of April this year, we felt that hell was breaking loose, and by the 31st of October, things seem to have subsided and stabilized, and we acknowledge that. There remain some challenges, but minor compared to what we were bracing for back in April. So this is the first observation. It's a relatively good news story where we stand today. The second observation is that trade has been resilient. Despite the last few quarters' uncertainty, trade has been resilient, and so we observe that 72% of global trade remains on WTO terms. This is down from 80%, but we're still talking high 70, in the 70s. Also, trade volume globally have increased by 2.9%. Again, this is down from 3.5% in 24, but we're still talking growth in global trade. The third observation is that trade has been reconfiguring. And this is exactly where the phrase Asia buys Asia comes in. This is one of the major reconfiguration of global trade, where we've seen effectively Asia starting to be much more engaged with itself through various intra-regional corridors, but also between Asia and the Middle East and other corridors around the world, somewhat taking, if you want, taking more prominence compared to what historically was the summary of global trade being China produces and then sells to the US consumer. That's definitely become much more sophisticated and nuanced today with Asia buying Asia. We believe Asia buys Asia brings about 1.8% additional GDP to Asia. So this is that much more wealth that will be created because of the Asia buys Asia. But this reconfiguration is also not only about the geographic reconfiguration, is also the content reconfiguration, and where we see now technology and AI goods contribute to about half of the growth in global trade. And we're seeing, of course, outside the trade in goods, trade in services grow at twice the pace of trade in goods. So there are definitely reconfigurations across geographies, content, and the substance that's behind it. The fourth observation, Arthur, I'd like to share is that trade is not only about trade. Trade has become a major driver of foreign direct investment and a major driver for employment. And we've seen that very clearly in ASEAN with Chinese foreign direct investment to build manufacturing capabilities, be it autos in Thailand, be it electronics in Malaysia, be it logistics in Singapore, et cetera, Vietnam, Indonesia have been also big beneficiaries. But also places like India and Mexico have been big beneficiaries of these FDI flows. So they bring with them hard currency, they bring with them employment, they bring with them wealth, they bring with them export capabilities. And they partly benefited from low wages in many of these countries compared now, for instance, to China. But also, the potential of this growth is massive, because when you look at the FDIs, from within Asia, specifically China, we remain at substantial, or multiples lower than the FDIs of some of the more mature economies, such as the US, Germany, the UK, Japan, Korea. So there is massive potential for more FDI to come. And then the last point I'd like to share about trade and supply chains is that the US will have a different role in global trade. The first thing is the US was the consumer of last resort. Anything manufactured on this planet would find buyers in the US if they couldn't find buyers anywhere else. And that probably will not be the case anymore. Or if it is the case, it will come at a price. And that's a base tariff to access the US consumer. And we just need to be factoring this in the future as part of the US being more self-reliant than it has been historically.
Yeah, thanks, George, for those trends. All you've mentioned actually creates a lot of opportunities for the region, the APAC region as a whole. But apart from opportunities, are there any risks that we need to watch out for in those kind of landscape?
So Arthur, definitely creates lots of opportunity. I just take the opportunity to say that we have, on the 9th of October, announced an offer to invest more than $100 billion Hong Kong dollars in Hong Kong with our offer to take private Hang Seng Bank. So hopefully that talks by itself about the conviction we have in the opportunity we see in the space. But if I talk about the risks, there are a number of risks. Certainly, a big risk is the technology disruption. Adopting it is an opportunity. Missing out on it is going to be a major risk. And it still comes with some of its challenges. Adopting blockchain is a major opportunity. We already rolled out tokenized deposits for our customers in Hong Kong and a number of other jurisdictions. We're participating to the e-Hong Kong dollar. We're participating to Project Ensemble for the interoperability of blockchain. All these opportunities are real, but there's still a lot that's happening on the blockchain away from regulated financial services in some of these unregulated stablecoin issuers. And that's a threat because it's an activity we cannot engage in being regulated and living by different standards than some of these issuers. Hong Kong's addressing that through a recent regulation on stablecoins, but obviously it's still a major global challenge. And then the second, I'll mention the second opportunity and challenge, of course, is generative AI and large language models. Opportunity in how we can improve customer experience, productivity, coding, efficiencies, how we can improve fraud detection, and I can go on, simplification of organizations, et cetera, all of which we're dipping into. But it is a challenge because obviously the expertise remains somewhat limited, the compute power remains somewhat challenged, and the use cases and the benefits cases aren't yet proven. We're still trying to prove them.
Thanks, George, for that. Let me put that a question related to what you're saying to put that questions to Bill. So your firm has been investing in China and Asia Pacific emerging markets in particular. What do you see are the more compelling investment opportunities now in this part of the world? And related to that, this part of the world is still soldiering on in terms of sustainability-related investments. GA has been leaning into climate and sustainable infrastructure with your Beyond Net Zero and Actis. Do you still see that as a major sort of trend? And given the current global environment in some of the major markets, are you seeing sort of backpedaling?
Well, there's sort of two questions in there. One related to where are the investment opportunities here in Asia, and the second related to energy transition and climate. And I'd start with the first and just say I think that China still represents an incredible opportunity for new investment related to innovation, entrepreneurship. And there's a new cycle of entrepreneurship, I think, happening in areas like life sciences, med tech, some in energy transition, consumer electronics. And just having spent a week in mainland China, I was amazed just at how a new generation of entrepreneurs are carrying forward. So I think it's very hard to not, if you're a growth investor or someone who's focused on innovation, it's hard not to put China at the top of the list in terms of opportunity set. I think India is also having its digital decade. If you look at some of the facts over the last 5 to 10 years in India. I mean, you have Jio, the mobile internet provider, over 500 million users. Their Alipay equivalent, a company called PhonePe, has 600 million daily users, and the payment system has been largely automated in India. So I think India is having a really significant moment in terms of its, innovation and entrepreneurship that's happening. So I think those have to be at the top of the list. And I think despite the fact that the pendulum swings in terms of, the attractiveness of sustainability, energy transition, climate change, I think the reality is we're in for an energy transition that's going to take place over 25 years, and we're going to need a lot of capital to be invested to facilitate the energy transition, and we're going to need a lot of new technologies. And that's been our focus, is what are the technologies that will facilitate energy transition, sustainability, as the demand for power around the world is, if anything, it's inflecting up significantly because of AI. So I think the opportunities for that theme, the energy transition theme, are alive and well, and will be for a while.
Yeah. Thanks. Just a quick remark. It's okay to talk about green in Hong Kong. You can still use that word. Okay. Let me turn to Colm. Switzerland. I really want to talk to you about Switzerland. Switzerland has always benefited from periods of uncertainty because Switzerland, because of its neutrality, because of its financial stability all along, it always benefits from these kind of uncertain environment. How do you see Switzerland fitting into the current landscape?
Well, I think Switzerland is not quite as big a country as we realize. It's 9 million people. It's the center of global wealth management, or was rapidly being approached by Hong Kong and Singapore. It has always been a neutral country and has benefited from that. In many ways, it's cost it, because the Swiss franc as an overspill currency, as a reserve, gets very expensive. But Switzerland is facing a crossroads here, because it's facing some major challenges. For the first time, it's facing a threat in global wealth management from centers like Hong Kong and Singapore. Secondly, its pharmaceutical industry is being hollowed out as a result of the tariff talks and so on, and relocation of manufacturing. And thirdly, it's having a bit of an identity crisis about what its role is in world banking. I'll talk about that separately. So I think Switzerland is losing some of that luster as other centers are now competing with it for capital.
Do you see that as a competitive relations, or are there any other way of putting these markets together to collaborate? Like Hong Kong, Singapore, you mentioned, that quickly catching up?
Well, the world is an increasingly linked place from a regulatory point of view, and we have two major disconnects in global regulation. One you've heard me talk about before, which is the lack of regulation or effective regulation in the shadow banking system. I'm not trying to upset anybody in this room like I did a few years ago. And the second one is actually, if you look at the regulated banking industry, you've now seen a different speed in terms of, let's call it simplification, whether it's the US, which is leading the way, quite rightly, I think, because the US has decided that capital is yesterday's problem. And what you need to do is, having settled the issue of capital for banks, you need to have effective regulation to let economies grow. And slowly the UK is following. The ECB doesn't quite know what to do yet, and Switzerland is going the other way. So, so you've got these two big trends in global regulation, one where there's lack of effective regulation, and the other where there's a disparate speed in regulation.
Interesting that you mentioned regulation repeatedly, because one of the areas that we want to talk about is deregulation, because increasingly I've heard that word being mumbled in the international community, particularly amongst the major markets. If I want you to pick one area of regulation that you think can be simplified or deregulated, what would you pick?
Well, I think the US is doing it. They're talking about deregulation. In fact, what it is simplification and focus on what needs to be done. Let's take an example. Everybody says that Silicon Valley Bank was a failure of regulation. It was a failure of regulation because of incomplete application of the rules that were in place. There already were rules, but the regulators did not apply those rules properly. They got too caught up on orthodoxy, on rule application itself. When you have a CCAR submission that's 125,000 pages, who reads it? When you have 450 regulators sitting in a bank every day, what are they doing? I think this is what the current administration in the US is trying to do, is trying to assess what is the risk, what are we trying to do? And in fact now, if you look at what's happening in the UK with respect, and certainly with the SSM in Europe, what we've got is total form over substance. And I think this is something that people are now trying to change.
It's interesting you mentioned CCAR. I trust that means that you think FINMA is doing all the right things. Sorry, you don't have to answer the questions.
Thank you, Arthur.
George, your pick of one area for simplification, deregulation?
So I'll probably pick two, if you allow me, Arthur. The first one is prudential. We've all been told Basel III is the solution of unification of prudential regulation across the planet. Basel III has gone in all sorts of different directions. Actually, even the name, is it Basel III, 3.1, 3.5, Basel IV, Basel III Endgame, and I can go on.
3.
That's the Hong Kong. Yes. So, but the substantive problem is still there. We have very different interpretations of Basel III, some of it known, some of it unknown, but definitely more on the diversion track. And that's not helpful. That's not helpful because of financial markets are inherently international, and if you're not playing by the same rules and the same standards, there is going to be risks of concentrations in areas of activities that is going to become unhealthy. The second area I want to call out is regulation of the fully unregulated space of stablecoin issuers. Now, arguably, some of the non-bank financial institutions have lighter regulation than banks, but at least we're playing by the same standards of financial crime, the same standard of regulation, and then we can argue about how light or not light. But there are segments of the world of finance that are totally unregulated. They're called DeFi, or they used to be called DeFi, and inherently go against what central banks stand for, which is centralization of finance. So there is a real risk that that this is a totally segregated space where businesses are being done, where consumers are putting money, where the prudential rules are at best a list of suggestions, and where financial crime rules are abhorred because they're, anonymous payment is really the name of the game, and we know what anonymous payment can lead to in terms of financial crime risks. And that is a real risk that we face, that consumers someday may face challenges, and no one here from the regulated industries is supposedly here to support them.
Thank you. Turning back to you, Colm, just very quickly, this topic about deregulation or simplification, it was actually founded on the basis that we're entering an era of slower growth, and therefore policymakers do need to strike the right balance between stability, financial stability, and growth and developments. You think that balance could easily be struck? And is that an impossible sort of dual goals?
Look, I think regulators lost control because in their desire to over-regulate the banking system, they chased a huge amount of product out of the banking system into the shadow banking sector, which is not regulated on the same basis. And if you look at what Besant is doing in the States, it is trying to kickstart the economy. It's trying to feed lubricant into the economy to get banks to lend more because they can control that. But no, I don't think they do have control. For instance, let's take, and I hope I upset nobody in this room now, but let's take the insurance business, right? Increasingly, an insurance business, particularly in the States, is regulated on a state-by-state basis, not a national basis. We're beginning to see huge rating agency arbitrage in the insurance business. Remember, in 2007, subprime was all about rating agency arbitrage. What you're seeing now is a massive growth in small rating agencies ticking the box for compliance of investment. And these things actually, whereas a few years ago I got into trouble with my good friend John and Mark for mentioning private credit. Let's not talk about that anymore. If we look at that, to me was never systemic. That was fiduciary. But if we look at the insurance business, to me there is a looming systemic risk coming through, and it's because of lack of effective regulation.
Thanks. Finally, we have a little bit of time left. Can we turn to AI? And for that one, I would turn to George and Bill. The AI-related investments. First of all, to George, this is really a mega trend right now. I checked the data in the past 2 months alone. Something like 20 billions of financing have been poured into constructing data centers across US and Europe for AI purposes. What do you take of this trend?
So Arthur, this is a tricky question because first the numbers actually are staggeringly higher. Well, at least the commitments are staggeringly higher. We're talking multiple hundreds of billions of dollars, if not into the $1 trillion of investment data centers. It's tricky because on the one hand, we need the compute. And for all users, be it personal or corporate, we can see that the compute becomes sometimes a challenge and the availability and the speed of reaction is not there. But on the other hand, the revenue profiles can't necessarily match can't necessarily justify the spend. Consumers aren't ready to pay for it or very low, and businesses are ready to pay for it, but they're going to be cautious because the benefits cases will not materialize in productivity in a year or two. These are like 5-year trends, and therefore, the ramp up means that we will start seeing real revenue benefits and real readiness to pay for it probably later than the expectations of investments are.
Yeah. Then turn to the investor perspective, Bill.
Yeah, it's been, first of all, I think it's hard to overstate the impact that AI is going to have over the long term on the overall global economy, the tech sector, et cetera. And I think that's why you've seen somewhere between $750 billion and $1 trillion invested already. I mean, the estimates are another $500 billion next year. And I think this is because people recognize the long-term impact that's going to have. But like so many new technologies, there is going to be misallocation of capital destruction, overvaluation, irrational exuberance. But I do think long-term, you're going to create a whole new set of industries and applications, and there will be a productivity payoff. But that's a 10, 20-year play. But the problem is you need to make the investments now. Unlike the internet, this cycle is very capital intensive, and you need to sort of pay up front for the opportunity that's going to come down the road.
And as George has mentioned, the return profile is very different from the internet age.
It's hard to pick winners and losers right now, and it's hard to know the exact nature of the return. You're really betting on this being a broad-based technology, more like railroads or electricity, that had profound impacts over time, but and reshaped the economy. But we're very hard to predict exactly how in the first few years.
Yeah. Okay. Thank you very much. We have used up all the times allocated to us. Let's put our hands together for the generous sharing by the panelists. Thank you very much.